Why do stock markets suddenly crash, even when companies are performing well? Why do markets rally, even when the economy looks weak? And how can just a few words from a central bank move trillions of dollars in seconds? You've probably heard terms like rate hike, rate cut, hawkish, dovish. But if you're like most people, these words sound complicated, confusing, and sometimes even contradictory. Here's the truth. If you don't understand interest rates, you don't really understand how financial markets work. But once you do, everything starts to make sense. Let's break it down step by step. Here's where most investors get stuck. You see headlines like, central bank raises rates, market falls. Then another day, central bank raises rates, market rises. So naturally you think, wait, isn't that the same news? This creates confusion. You might feel like, markets are unpredictable, news doesn't make sense, investing feels like guessing. And because of that, many people hesitate, overreact, or make emotional decisions. But the reality is, markets are not random. They're reacting to something deeper, and that something is interest rates and expectations. And once you understand this, you'll start seeing patterns everywhere. Let's start from the foundation. Interest rates are simply the cost of borrowing money. If rates are low, loans are cheap, businesses expand, people spend more. If rates are high, loans are expensive, spending slows, growth cools down. So in a very real sense, interest rates control how fast or slow the entire economy moves. A rate hike means the central bank is increasing interest rates. Why would they do that? Usually to fight inflation, when prices are rising too quickly. By raising rates, borrowing becomes more expensive, and that helps slow down inflation. But there's a trade-off. Slowing inflation often means slowing the economy too. A rate cut is the opposite. The central bank lowers interest rates to encourage growth. This makes loans cheaper, spending easier, investment more attractive, so the economy gets a boost. But again, there's a trade-off. Too much stimulation can lead to inflation later. Now we move into one of the most important concepts, hawkish and dovish. This isn't about what the central bank is doing right now, it's about their attitude and priorities. A hawkish central bank focuses on controlling inflation, is more willing to raise rates even if it slows the economy. A dovish central bank focuses on supporting growth and jobs, is more willing to cut rates even if inflation rises slightly. Here's the most important insight. Markets don't react to what's happening today. They react to what they think will happen next. That's why a rate hike can be bullish, a rate cut can be bearish. It all depends on expectations. Let's look at 4 scenarios you must understand. Scenario 1, hawkish plus rate hikes. This is when inflation is high and the central bank is aggressively raising rates. Stocks struggle, currency strengthens. Scenario 2, dovish plus rate cuts. Growth is slowing and the bank steps in. Stocks rise, risk assets perform well. Scenario 3, hawkish plus rate cuts. Tricky. Rates are cut, but they're still worried about inflation. Volatility increases. Scenario 4, dovish plus rate hikes. The economy is strong, rates rise slowly. Market interpretation, the economy is healthy. So what's the big takeaway? Interest rates are the foundation. They control liquidity, and liquidity drives asset prices. Instead of reacting emotionally, ask smarter questions. Are rates rising or falling? Is policy tighter or looser? Is it hawkish or dovish? Because once you understand this, markets stop feeling random. You stop guessing, and you start seeing the logic. Because behind almost every major move in markets, there's one force driving it all: interest rates.